Hi everyone, my name's Anthony Beardsall. I'm going to do a short series now on trading US stocks using contracts for difference and spread betting. Now, many of you will know that I've specialized over the last few years in technical analysis on the short-term charts, so the 1 minute, the 2 minute, 3 minute, 5 minute charts for day trading. And typically I've been trading the DAX and all the Forex markets, and at the moment volatility is quite low, and so I'm having a good level of success and spending half an hour or an hour a day trading US stocks on the open. And I'm going to talk you through today one of the trades that I took yesterday, and just show you how the analysis is the same for trading these US stocks as it is for trading the indices according to the methods that I've developed over the years. So let's have a look at this. The chart in Tencent Music Entertainment on 12th of November 2019, and you can see that this was the open here, and I took two trades within here, both short trades, and I've taken this screenshot just as I exit the trades. Okay, so for people who've followed my trades, you'll know that I have on my charts, I have the 8 exponential moving average, the 20 exponential moving average. This is a 1 minute chart. This is the open here, and you can see something that you don't see normally on indices, and you can see that you've got a gap here with no printed bars here. The printed bars for here are way up here, and that's because we've had a gap down. So when I'm trading US stocks, I'm looking for stocks to trade in the first hour after opening, so UK time, that's 2:30 p.m. to 3:30 p.m. and I'm looking for the stocks that have got momentum, so stocks that have dropped in value overnight and stocks that have risen in value overnight. And what I'm looking for is continuation of the momentum that has taken place overnight. So in this market, the market fell overnight, and then the first bar of the morning was this one, which is a big red bar, it's a sell bar. And very often what happens with these type of moves when the market's got momentum is that you will get a further move in the same direction after a period of consolidation. This market was going sideways here during this period here, and it wasn't going down, it wasn't going up, it was going sideways. It was basically finding value, and when a stock that's falling finds reasonable value, then you'll find that people will come in, traders will come in, and they'll sell it. And this is what happened, and the market came down. So I'm using the same principles that I always use to take trades, short-term trades in this type of market. Okay, so we've got the gap down, and what am I looking for? Well, I'm not going to take the trade short straight away because I want the market to find value. Sometimes the market can come down and then bounce, and when it bounces and leaves a tail like that, I'm on alert because we've had a drop, an initial drop, market's rejected at the bottom here, it's found buyers. In actual fact, probably what's happened is that the people who've sold overnight, sold early, will take profits, and the market will just rise gently. And then the people who are looking to short the market will sell again, And this is what happens. They sell again, take profits, sell again, take profits. And this is generally what happens. Now, as a retail trader, what I'm looking for is I'm looking for decent value first of all from my broker. So the charge for trading CFDs in US stocks is the spread. So you can see here you've got a sell price of $13.22 and a buy price of $13.28. So there's a 6-cent charge, 6-cent spread, which is pretty good. And so I'm going to be looking, these are 6-cent gaps here between the numbers, and so I'm going to be looking for a 30 to 50 cent move, and out of that I will pay the initial spread, and the remainder, if it goes in my direction, the market goes in my direction and I'm right, will be my profit. Okay, so with 1,000 share position and the market moves 50 cents, then you're going to be looking at 500 pounds. If we're working in pounds, 500 pounds profit less the spread, which would be 6 cents, so 60 pounds. So yeah, for a 50-cent move, 400 odd pounds profit is pretty good. So that would be, that would be 1,000 share position. You can take 20 share positions if you want, or you can take 20,000 share positions. It depends on the money that you've got in your account, but the maths is the same. So I'm looking for the market to go down, bounce, and then I'm going short. So my first short was when the market came up to the 8 moving average. Okay, so it came up and bounced, and I'm in short here. This is at 1362 here on the close of this bar. Market came down, got a low here of 1345, something like that, which is not enough profit for me to exit my first trade at this position. But the reason for the trade was because I've had a gap down, the market's bounced, it's come up to a moving average, it's found good value, and I'm expecting it to start falling again. You've got a mini trend line here which has been broken, and the market's dropped below the low of this bar, and this bar, and so short at this stage. And then the market again is leaving tails, 1, 2, 3, 4, 5, 6 tails here, all suggesting that the market is consolidating. But when it consolidates and it's below the moving averages, then I expect, and longer term momentum is short or is selling, then I'd expect the market to reach a value level and then fall. So I'm looking out, I'm still holding my first position, and I'm looking out, and let's have a look. We've got a trend line here, which was just about there. Market came up to the 8 exponential moving average. I've got a protective stop above here for my first trade, and here it was my entry, so quite a small stop, and so the market's coming down, still in profit for my first trade here, but I'm going to be looking to exit that trade down here. And we've got the $13.50 mark here, which is a round number or a whole number almost, if you like. And so the market comes down below the 8 and closes below the 8. It comes back up on the open and gaps up on the open of the next bar, which was where I entered my second trade short, expecting the market to drop immediately, which it did on that bar, and the stop for the second trade is just up here, so very tight stop. I'm not using physical stops for these trades, I'm just using manual stops. I'm keeping my eye on the screen to watch the action, and I'm getting ready to exit. And one of the benefits of trading CFDs is that you can basically exit shorts and longs wherever you like, and it doesn't really matter on the size of the trade. You know, if I've got a 20,000 share position and I'm trading shares, I have to wait for the for the buyers to come in and take my shares. But with CFDs I can exit at the market. So the buy price here, you can see 13.28, that's down here. Sell price 13.22, that's the spread, the difference between the two. So I'm waiting for the market to come down. I'm in two positions short at this stage. The market breaks this trend line. Sure, it was not really an uptrend. That's just consolidation. It's flat. There's a squeeze. You can see the triangle. There's a cup and handle formation. All of these are familiar to us as technical traders. The formations are the same, the take profit levels are the same, the principles in trading are the same, regardless of the market that you're actually trading. And these American markets with shares with big momentum offer good opportunities when the spread is right. Now, if later in the day what you tend to find, this is 254 here, later in the day the spread widens as the traders start to lose interest in the stocks. The spread widens and it becomes really not worthwhile. The volatility becomes lower and these gaps become lower, and it's not worth trading at that point in time. But when the market's hot and this stock's moving, then it's worth it because it's got momentum on the downside, and the market starts moving down. You've got rejection, indecision bar here, rejection here off the 8 exponential moving average, and the market starts moving down. It breaks the 1350 level quite nicely, rejects going up above it, and the market comes down. And there we go. So at 13.20 we've got a nice profit of 30 to 40 cents, which on the position size you can work out how much your profit would have been based on the number of shares that you buy. But if at 30 to 40 cents on a move with a charge of just 6 cents, that's quite good value and good to take profits when they're on the table. You've got to keep paying yourself when you're day trading. And for me that's time then. It's 3 o'clock, just after 3 o'clock in the afternoon. The stocks stay hot until at least 3:30, so they 2:30 to 3:30, 2:30 being 9:30 New York time. But stocks are hot for that first hour. They're moving quickly, and some of them will stay hot all day, others won't. This one won't. It'll tend to fizzle out and just tail off and do nothing for the rest of the day. But while the iron's hot, if you like, then we need to strike, and we did. So that's the first video on trading CFDs on US stocks. I hope you found that useful. You can buy, you can sell, going long, buying, going short, selling, depending on what the stock is doing and where the momentum is. And just a word of caution to watch the spread on these stocks and make sure that's worthwhile. If you've got a 30-cent spread and the up moves and the down moves are only 30 cents, then you're going to find it difficult to pay the charges and make a profit as well. So just watch that. But where you pick your markets, you'll need to be looking at 3, 4, 5, 6, 7 stocks at the same time. So you're going to require the monitor setup to do that, and the broker as well. So, hope you found that useful. My name's Anthony Beardsall, back with another one soon. Cheers for now. Bye.